Hi everyone, welcome to the third topic of financial accounting, that is final accounts. In our previous topic, that is the second topic, we looked at the ledger and the concept of double entry. So in that topic, we recorded transactions in the ledger through the concept of double entry, and then we balanced off the accounts. Then after balancing off the accounts, you prepare the trial balance. So now, after preparing the trial balance, that is at the end of the year, accountants will be needed to prepare the final accounts. So it is after preparing the trial balance in the accounting cycle that businesses will prepare the final accounts. So these final accounts are at this level. We shall look at only three of them. That is the trading account, the profit and loss account, and the balance sheet. Before I move on to these final accounts, I want us to look briefly at the accounting cycle. So there you can see the accounting cycle in the form of a chart. The accounting cycle basically covers the definition of accounting. So what accounting is. You remember that in our first topic we said that accounting and bookkeeping means the process of recording business transactions in the books of accounts, then analyzing and classifying these transactions and reporting the impact of these transactions on the financial position and performance of the business. So accounting is simply a process. So this process can be summarized in the form of the accounting cycle. So the accounting cycle, as you can see then, is in the form of a chart. At the beginning, we identify transactions. Transactions, that is activities that are of a financial character that affect the financial position of the business. So once we identify the transactions, we record them in the books of accounts. And that is by posting, recording is number 2, and that is by posting into the general ledger, number 3. Once you post into the general ledger, you prepare the trial balance. I believe we have done all this. Yeah, we've identified, in our second topic, we identified transactions, we recorded them in the books of accounts, we posted them in the ledger, and we also calculated the trial balance. So we've covered up to step 4 of the accounting cycle. Then after preparing a trial balance, we usually have some adjustments. So we shall cover adjustments in the next topic, that is final accounts and end of year adjustments. So once you make adjusting entries, then you have an adjusted trial balance in step 6. Then once you have prepared the adjusted trial balance, you move on to step 7 and prepare the final financial statements, or simply the final accounts. So it is at step 7 that we prepare the final accounts. So that is where we are today. So the financial statements in this case include the trading and the profit and loss account and the balance sheet. And then once you are through with the financial statements, we then end with making the closing entries at the end of the year. And then the process repeats itself in the subsequent years. So that is the accounting cycle. So then now we go back to the final accounts. We've said that there are only 3 at this level. We look at the trading account, the profit and loss account, and the balance sheet. So one thing to note is that nominal account balances, that is revenues and expenses. I hope you remember the classification of accounts. So we have personal accounts and impersonal accounts, and then under the impersonal accounts, we have the real accounts and nominal accounts. So where we have nominal accounts, in case of nominal accounts, that is revenues and expenses. Yeah, we post this in the trading and the profit and loss account. So nominal accounts should be shown in the trading and the profit and loss account. So in short, revenues and expenses are normally posted in the trading and the profit and loss account, while the real and personal account balances are reflected in the balance sheet. So real and personal account balances are shown or are posted in the balance sheet. So in short, real accounts you see are assets, the tangible assets, like the fixed assets, the long short-term assets. And then personal accounts, those accounts with the name of a business or person, who may include creditors, debtors, and capital. So assets and personal accounts should be shown in the balance sheet. So as an examiner, I don't expect to see an asset in the trading and profit and loss account. Assets should go to the balance sheet. So this is a very important point to note, that nominal account balances, that is revenues and expenses, should be shown in the trading and the profit and loss account, while real and personal accounts should go to the balance sheet. So you look at the first final account, that is the trading account. So the trading account is a financial statement which shows the gross profit arising from sales and cost of sales. So in the trading account, we show the sales, we show the gross profit, of which gross profit is equal to sales minus cost of sales. Yeah, so the gross profit is equal to sales minus cost of sales. So as you can see in that formula, gross profit is equal to sales minus the cost of sales. So cost of sales is also computed, and the formula for determining cost of sales is the opening stock plus purchases minus the closing stock. Yeah, or in summary, in short, the cost of sales is equal to the opening stock plus purchases minus closing stock. So when you less the cost of sales from the sales, you get the gross profit. So therefore, gross profit is equal to sales minus the cost of sales. So I hope you get that. The next, we move on to the second final account, and that is the profit and loss account. So this is a financial statement which shows the net profit, of a business arising during a given accounting period. So the net profit of a business is equal to the gross profit plus other revenues minus other expenses. So you've computed gross profit up here, that is in the trading account. When we move on to the profit and loss account, we show the net profit, of which the net profit is equal to the gross profit plus other revenues minus other expenses. And here, when we talk of other revenues, we're talking of the revenues of the business excluding sales. So other revenues here exclude sales revenue, because sales has already been captured when computing the gross profit. So in our gross profit here, we talked of sales. So in this case now, in computing the net profit, since we are using gross profit, the sales is already captured in the gross profit. The same case with purchases. Purchases are also covered in the gross profit. As such, other expenses in this case, when computing the net profit, will exclude purchases. So therefore, we need to note that other revenues, when computing the net profit, will exclude the sales revenue, and other expenses will exclude purchases when computing the net profit. So that is the profit and loss account, which shows the net profit. So we proceed. So we have the trading and profit and loss account. So in most cases, you find that businesses will combine these two accounts together. So businesses will combine the trading account and the profit and loss account into a single financial statement that is known as the trading and profit and loss account. So the trading and profit and loss account is a financial statement that combines the trading account and the profit and loss account, which means that it shows in one statement, in one financial statement, The trading and profit and loss account shows the net profit, and it also shows the gross profit. So the trading and profit and loss account, so it is a standard accounting procedure to combine the trading account and the profit and loss account into a single financial statement, which is known as a trading and profit and loss account. So the trading and profit and loss account is also known as the income statement. So the format of the income statement is as below. So it must have a title, and in the title, there has to be the business name. So you need to know the financial statement is prepared for which business, and then the title, the title of the financial statement. So in this case, the trading and the profit and loss account, and then it has to specify the period for which it has been prepared. So for the period ended, so it could be for the year ended, a particular day of a month of a given year. And then we show the particulars down there of the financial statement. So now this being a trading and profit and loss account, it should show the net profit and the gross profit. So we begin with the gross profit. So the gross profit, as we said, is equal to the sales minus the cost of sales. So that is what we show here. That is the sales minus the cost of sales. So in our case here, the highlighted section shows the sales. So we shall therefore have sales and its figure there. Yeah. So X could be a given amount of money, say 10,000 shillings. And then in some cases, we may have returns inwards. So if you have returns inwards, we deduct them from sales in order for us to get the net sales. Yeah, so that will give us the net sales of the business for a particular period. Once we are through doing that, we calculate the cost, we less the cost of sales. And we've said that the cost of sales is equal to the opening stock plus purchases minus closing stock. So that is what we show here. So we have the opening stock, then we add purchases. So our purchases are covered there. Add purchases, its figure is, for purchases is that. And then in some cases we may have returns inwards. If we have returns inwards, we deduct them from purchases to give us the net purchases. So returns inwards are goods that sorry, not in this case it's returns outwards, sorry. So returns outwards are goods that we had bought, and then for some reason we return them back to our supplier. So when we return goods back to the supplier, we credit that in the returns outwards account. So when we have returns outwards in the trial balance, we deduct it from purchases in order for us to get the net purchases figure. For returns outwards, these are goods that we had sold, but for some reason, they were returned back to us by the customer. So when the goods are returned back to us by the customer, we debit those in the returns inwards account. So the returns inwards account has the effect of reducing our sales. So if you have returns inwards in our trial balance, we deduct them from sales in order for us to get the net sales. So back to our cost of sales. So of the opening stock, we've done that. Then we add purchases, and in some cases we may have carriage inwards. So if you have carriage inwards, we add them to purchases. Carriage inwards are transport charges on goods purchased. So we incur charges to deliver goods to our business. Yeah, for instance, we use a motor vehicle. That motor vehicle will need fuel. That fuel is a cost to the business. So that fuel is part of carriage inwards. So if we incur carriage inwards in transporting goods to our premises from the supplier, then we have a carriage inwards balance in the trial balance, which needs to be added to the purchases when computing the cost of sales. And then we less the closing stock. So in this column here, so we have the opening stock plus purchases covered here, and then minus the closing stock. It will give us the cost of sales. So remember, as per the definition, the cost of sales is equal to the opening stock plus purchases minus closing stock to give us the cost of sales. Now, when we have the cost of sales, then now we can deduct the cost of sales highlighted there from the net sales, which will give us the gross profit. So that the gross profit. So this is the trading account part of the trading and profit and loss account. Then next, still within the same financial statement, we calculate or show the net profit. And we've said that the net profit is equal to the gross profit plus other revenues minus other expenses. It will give us the net profit. The net profit is equal to the gross profit, which is we have already done, plus other revenues minus other expenses. So we add other revenues. So other revenues excluding sales, because sales is already up here. So other revenues, for example, we may have rent income and interest received, assuming those are the only revenues that were earned during that particular period. So we add them here. So this should be in this column. So we add them, and this figure gives us the other revenues. And then we less other expenses. So other expenses could include we less other expenses, we add them here. So other expenses could include rent expense, interest on loan, bad debts, for instance, salaries and wages, advertising, and also carriage outwards. Carriage outwards being transport on goods that you're delivering to the customer. So assuming those are the only expenses that the business incurred, so we add them all together. They should be in this column. So once we add them all together, we end up with this figure here. This is an amount of money. So we shall do an example to illustrate all this. So once we get the total for the other expenses, we deduct from other revenues and gross profit, which will give us the net profit. So remember we said that the net profit is equal to the gross profit plus other revenues minus other expenses. So in our case, we have the gross profit plus other revenues minus other expenses, which will give us the net profit. Then move on to the balance sheet. The balance sheet is a third financial statement or final account, which is a financial statement which shows the financial position of a business on a given date. So this follows the standard accounting equation, that is assets, not assets. Assets being equal to capital plus liabilities. Yeah. So this is a financial statement which shows the assets, the capital, and the liabilities, and it follows the standard accounting equation. That is assets on one side is equal to the total of capital and liabilities. So the format of a balance sheet is as follows. So it must have a title. In the title, you have the company, the name of the business has to be there, so that you know the financial statement belongs to which business. And then the final account itself has to be indicated, and then it has to be on a particular date, as on a given date of a particular month of a given year. And that is the format of a balance sheet. We shall have an example to illustrate this. So on one side we have the assets, and on the other side we have capital and liabilities. So the assets, we have fixed assets. Examples of fixed assets is land and buildings, motor vehicles, plant machinery, and office furniture. Then we have current assets. Those are examples: stock, that is stock, debtors, bank, and cash. And then we add all these, we get the total assets. And then move on to the other side, we have capital. And capital is usually affected by net profit, the net profit that you've obtained from the income statement or the profit and loss account, minus the drawings that have been taken out by the owner of the business. And then we add long-term liabilities and short-term liabilities, which will give us the total of capital and liabilities. So this total of capital and liabilities should be equal to the total of assets. Yeah, for us to be correct. So in the balance sheet, the total assets should be equal to the capital and liabilities. So this total of total assets and the total of capital and liabilities should be equal. So before we move on to the preparation of final accounts, doing an example, there's one thing that you need to note about closing stock. Closing stock, okay, there are two types of stock for business, that is continuing, a going concern. We have opening stock and we have closing stock. So in most cases, in the trial balance, you will see the opening stock, but you will not see the closing stock. So closing stock should not appear anywhere in the trial balance, but opening stock should be there if it is there. So this, the reason for this is that stock is not part of double entry. So whenever you buy goods, whenever we make purchases, we don't record in the stock account. There's nothing like a stock account, yeah? So we record that in purchases account. So when we buy goods, we debit purchases account. When you sell those goods, we credit sales account. We credit the sales account. So we don't have debit and credit of stock account. As such, stock is not part of double entry, and therefore it doesn't appear in the trial balance because there is no account for stock. And it's only opening stock that appears in the trial balance. So the amount of stock is not determined by double entry, but rather it is determined by a stock taking, yeah, physical verification of stock, whereby someone goes to the stock and counts physically the amount of stock in the store. So it's not double entry that values the stock in the store, but a physical verification through stock taking. So I hope you note that closing stock shouldn't appear in the trial balance. So closing stock is therefore not shown in the trial balance, but rather, however, it is shown as an additional information in the trial balance. So then we have an example. We have an example.